Okay, stop what you're doing. Seriously, if you own Amkor Technology, ticker AMKR, or if you're even thinking about touching an AI-adjacent semiconductor stock right now, you need to hear this. Last week, I ran Amkor through 5 separate valuation models and 2 legendary investor checklists. And honestly, what I found completely shocked me. We are looking at a company that is quite literally holding the physical future of the AI boom together, yet its valuation is an absolute mystery.
Get this, there is a massive, almost unbelievable disconnect in how this company is being priced right now. When you run a strict discounted cash flow model using their fundamental metrics, Amkor's fair value sits at just $4.42. Yet, out there in the open market, investors are happily paying over $71 a share for it. That is a jaw-dropping gap. Literally a 94% downside if the strict DCF is right. It's the kind of stat that makes you do a total double take.
And that begs a really bold question, one that strikes right at the heart of every retail investor's worst fear right now. You know the exact fear I'm talking about. Are you buying at the absolute peak of an AI bubble right before it pops? Or is there fundamentally more to the story? Is Amkor a profoundly misunderstood hidden gem? Or is it a catastrophic valuation trap just waiting to spring?
To make sense of this, it helps to think of it like the ultimate picks and shovels operation of the modern AI gold rush. Amkor doesn't actually design the high-flying AI chips like NVIDIA or AMD do. Nope. Instead, they are the crucial microscopic glue. They're an outsourced semiconductor assembly and test provider, an OSAT. Basically, you absolutely cannot run a modern AI data center without them holding the hardware together.
So I promise you a clear, actionable framework to steal today. By the end of this explainer, you are going to know definitively if AMKR is a Warren Buffett buy or a Peter Lynch value trap. We're going to break down their massive Q1 earnings blowout, their role as an AI packaging superpower, their multi-billion-dollar global expansion, and finally, crack that bull versus bear valuation mystery. Let's get into it.
Section 1, the Q1 earnings blowout.
We aren't just looking at a lucky quarter here. We are looking at a fundamental structural shift. Amkor absolutely crushed expectations across the board. The market estimated $1.65 billion in revenue, but they pulled in a record $1.68 billion. That is a 27% year-over-year jump. But even more impressively, check out the bottom line. Earnings per share came in at 33 cents, totally obliterating the 24-cent estimate. For a mature, heavy manufacturing company to beat by that much on the bottom line, it tells us their facility utilization rates and operational leverage are optimized almost perfectly right now.
But hey, we have to stay objective. There's a massive tension dividing Wall Street at this exact moment. While the bulls are pointing to the explosive 37.9% trailing earnings growth over the last year, the bears, well, they're staring at a historical 5-year average earnings decline of 13.3%. So the bears are naturally asking, is this recent surge just a temporary AI-driven blip that's masking a fundamentally cyclical low-margin business?
Section 2, the AI packaging superpower. To resolve this conflict between the short-term surge and the long-term drag, we really have to dig into their core business. In simple terms, an AI processor and a high-bandwidth memory chip, or HBM, cannot just be slapped onto a regular motherboard and expected to talk to each other. No way. They have to be packaged together with microscopic precision to achieve those massive data transfer speeds. That is exactly Amkor's domain. As the world's largest US-headquartered OSAT, their advanced packaging capabilities are quite literally the physical bottleneck of the AI revolution.
So here is the absolutely crucial point. Out of their $1.68 billion in total sales this quarter, a staggering $1.37 billion comes directly from this highly complex advanced products category. They've effectively neutralized any weakness in the traditional PC markets by just completely dominating this high-end AI data center niche. Their advanced AI packaging revenue is literally on track to triple year over year. Think about that.
However, this does create an undeniable concentration risk. 68% of their total net sales are tied to just 10 giant customers. Now, normally this is a massive red flag, right? If one giant switches vendors, the stock plummets. But the bulls actually argue this is Amkor's superpower. Why? Because these aren't just interchangeable commodity components. These are deeply sticky, co-engineered partnerships. The equipment, the clean rooms, the testing protocols, they are customized over years for specific clients. That creates a massive barrier to entry for any potential competitors trying to swoop in.
Section 3, billions in global expansion.
Navigating this kind of locked-in demand means scaling up and scaling up aggressively.
Amkor is pouring a projected $2.5 to $3 billion into CapEx this year alone. We're talking about a massive $7 billion advanced packaging campus in Peoria, Arizona, with Phase 1 slated for 2027. On top of that, they are aggressively doubling their annual output in Vietnam to 1.2 billion semiconductor items, and they're expanding a new test building in Korea to meet the surging data center demand expected in 2027. It is a literal tidal wave of physical infrastructure.
Now, you might be wondering, how on earth does a company pay for all this without diluting shareholders into oblivion? Well, the good news for retail investors is they are funding this from a position of profound financial strength. They've got $1.8 billion in cash and short-term investments just sitting on hand. Plus, they secured a $400 million U.S. CHIPS grant alongside a 35% investment tax credit. Right now, against $1.4 billion in total debt, they technically have negative net debt, which is kind of amazing.
Yet all this heavy lifting definitely isn't without consequences. S&P Global recently revised their outlook on Amkor from positive down to stable. Why? Because this heavy debt-funded CapEx investment, which includes a new $1 billion convertible note, will temporarily push their leverage above the 1.5x mark. Furthermore, management actually expects the Arizona facility ramp-up to temporarily dilute operating margins by 1% to 2% starting in 2027 before it really scales. This is exactly what tests those bearish profitability narratives we talked about earlier.
Section 4. Bull versus bear valuation.
And this brings us right to the climax of our fundamental analysis. How do we reconcile the explosive growth with the heavy capital burden? Well, the bulls look at this and see a stock trading at a 40.5x price-to-earnings ratio. While that might sound a little high at first glance, it's actually a discount compared to the broader U.S. semiconductor industry average of 49.2x, especially for a company rocking 37% trailing earnings growth. The bears, on the other hand, rely on that strict, discounted cash flow model that heavily punishes the massive 2026 and 2027 capital expenditures. When you subtract all that cash going into Arizona and Korea, the DCF model spits out that shockingly low $4.42 fair value we mentioned at the start.
Historically, this constant push and pull between the bulls and bears is incredibly evident. If you look at their historical returns relative to the broader S&P Midcap 400 and the semiconductor index over the past 5 years, the volatility is wild. It's a stock that historically swings violently with the broader semiconductor cycles, which absolutely demands a really strong stomach from its investors.
Section 5. The final verdict.
Let's run Amkor through our legendary investor checklists to see where it truly stands. For Warren Buffett, Amkor boasts an incredibly sticky, high switching cost economic moat. I mean, when 68% of your revenue is tied to top tech giants through deeply customized, co-engineered clean rooms, your customers can't just leave for a cheaper competitor overnight. They're locked in. But Peter Lynch might look at this exact same situation and warn that a heavy manufacturing cycle, one that's actively diluting operating margins by 1% to 2% in the near term due to massive factory buildouts, could be a classic short-term value trap.
Ultimately, as Amkor pours billions upon billions of dollars into Arizona, Vietnam, and Korea, you really have to ask yourself a bigger question. Does becoming an indispensable physical pillar of the global AI supply chain make them the ultimate hidden gem, or does operating in an industry that is the absolute epicenter of global trade tensions make them a massive target for future geopolitical risk? That is the Amkor mystery you have to solve for your own portfolio. Thanks for joining me on this explainer, and remember, always keep questioning the numbers.